Here we are again. That's the opening line of a note published this month by Bobby Molavi, Goldman Sachs partner, someone who sits inside the flow and sees where institutional money is actually moving. And what he saw when he looked at this market should scare you. The CAPE ratio, the cyclically adjusted price to earnings ratio, the broadest long-run valuation measure we have, sits at 41.4 right now, July of 2026. Second highest reading in 145 years of recorded data, higher than September of 1929. The only reading ever worse was December of 1999 at 44.2. Molavi looked at that number, then he looked at momentum collapsing harder than any single dot-com month. Then he looked at the AI CapEx structure, the geopolitical shock, and retail leverage, and the takeaway from his note was essentially this: fingers crossed feels like an investment thesis, and that should worry everyone. By the end of this video, you'll know exactly what the Goldman partner saw, why the momentum signal is far more alarming than anything the index is showing you, and what the single point of failure is for the entire AI trade right now. And if you just look at the index and think the market is calm, you'll buy every dip for the wrong reason, at the wrong level, every single time. Let's start with who Molavi is, because it matters. Goldman Sachs partners aren't macro commentators. They sit inside the flow. They see where real institutional money is moving in real time. When someone at that level opens a note with, "Here we are again," you want to know what again means. The CAPE ratio goes back to 1881. That's 145 years of data across depressions, wars, oil shocks, and tech bubbles. In all that time, the FT points out that there have only been three huge peaks. September of 1929, 32.6, December of 1999, 44.2, and July of 2026, 41.4. The long-run mean on this ratio is 17.8. We're at 41.4. That's 2.3 times the historical average right now. And the 1929 reading was 32.6, lower than today's. What followed that reading was a 90% wipeout in the Dow. 90%. Throw in the Buffett indicator, total market cap divided by GDP, and it's above 200%. Buffett once called levels approaching 200% playing with fire. We're already there. This isn't a stretched market. This is a third in recorded history valuation event. The first time it happened at this level, markets lost 90%. The second time, the Nasdaq lost 80%. But valuation alone doesn't tell you when. It never does. What Molavi is watching is something moving right now, something the index is almost completely hiding from you. If you just look at the S&P right now, it looks fine, relatively stable. That's the lie. The momentum factor, the trade where institutionals buy what's been going up and short what's been going down, is the most crowded institutional trade on the planet. And it's down 24% in July. 1 month, 24%. This is on track to be the worst single month for the momentum trade since the 2008 financial crisis. Not the dot-com crash, 2008. And the volatility of the momentum factor relative to the S&P is at a new all-time record, 4 times. The previous peak was 2 times. That was COVID. During the dot-com crash, it was 1.8 times. We're at 4. The names getting hit are NVIDIA, Supermicro, Palantir, D-Wave Quantum, Western Digital, CoreWeave. These are the stocks institutionals piled into on the AI trade, and they're unwinding fast, while the index drifts sideways. The market is not calm. It's calm at the index level. Underneath, you're seeing the most violent momentum drawdown since 2008, with volatility that's never been this extreme. Institutions are degrossing, cutting into their long and short exposure simultaneously, while retail looks at the S&P chart and sees nothing happening. But here's what makes this different from 2008 or the dot-com. This time, a single narrative is holding the entire structure together, and something just happened that threatens to crack it. The AI trade isn't just a stock theme, it's a capital structure. The hyperscalers, Microsoft, Google, Amazon, Meta, the companies building the actual infrastructure, are funding this CapEx cycle with cash, debt, and equity simultaneously. Nation-state deficits in the US depend on AI growth showing up. More productivity, more tax revenue, more nominal GDP to service the debt. This isn't a sector bet. It's the entire load-bearing wall of the 2020s growth thesis. And that wall rests on one assumption, that the US frontier AI justifies the cost, that the moat is real, and that nobody can close the gap. Then Moonshot AI released Kimi K3. The gap between US AI and Chinese AI just narrowed, materially. The entire cost justification for this CapEx cycle was, we're so far ahead that the returns are guaranteed. Kimi K3 is a direct challenge to that. Revenue compresses, CapEx reverses, the feedback loop that was running forward starts running in reverse. Molavi wrote, "This better work." That's not pessimism. That's a Goldman partner looking at the AI CapEx structure and acknowledging out loud that it doesn't have a plan B. Layer on the geopolitical shock. Iran has hit Kuwait, Bahrain, and Saudi Arabia. For oil to match the 1979 Iranian revolution shock, prices would need to be 4 times higher from here. Higher inflation, higher rates, debt-funded CapEx gets more expensive right at the moment the revenue case is being questioned. The single point of failure is the continued belief that US frontier AI justifies the cost structure underneath it. Kimi K3 is the first public challenge to that belief that the market can't really dismiss. And if that narrative cracks, the question isn't whether AI stocks go down. It's what happens to all of the borrowed money stacked up on top of them. Every prior crash had an arrest mechanism. In 2008, the Fed cut rates to zero and bought trillions. In .com, valuations got cheap enough that fundamentals could make a case. In COVID, fiscal stimulus hit in weeks. There was always a floor, either from policy or from price. Olavi is pointing at something different now. All 3 of those mechanisms are more constrained than they've ever been at the same time. And the leverage layered into this market is in places where standard margin data won't find it. At the retail level, double and triple leveraged ETFs, retail investors buying SpaceX on margin, a private company where you can't even get a public quote, perpetual futures with no expiry, and no natural settlement floor. None of that has a built-in bottom. At the institutional level, margin loans, cap call financing, NAV loans, GP carry financing. None of this shows up in the traditional margin debt numbers that get reported in the financial press. It's all invisible until it isn't. When degrossing starts in earnest, and it's already started in the momentum factor, correlations go to 1. Everything drops together. Diversification disappears at exactly the moment you need it. And the central bank backstop? The Fed has already cut rates. Balance sheets are already elevated. The Fed can still act, but it's starting from a more constrained position than it did in 2008 or COVID. It has less room. It fires slower. It arrives with less force. That's what fingers crossed actually means. It's not a dramatic closing line. It's an accurate description. Someone with full visibility into institutional flows, who has every professional incentive not to say this out loud. He looked at CAPE at 41.4, momentum down 24% in a single month, a cracking AI narrative, and a leverage stack with no floor. And the honest summary was, fingers crossed. That's not pessimism. That's the most precise description available for where this market actually is. The question now isn't whether these risks are real. Molavi has already answered that. The question is what you know, what you're watching, and whether your position to act on it before the next leg down makes the decision for you. You now know what the Goldman partner saw. You understand why the smartest money in the room couldn't build a thesis, only a prayer. But that knowledge alone won't keep you on the right side of the trade. Here's what understanding that story also doesn't give you: the truth about price. It gives you a narrative, and narratives matter, but price is what tells you whether the narrative is true or not. The measured move is a framework for understanding the direction of price. It tells you whether this narrative is being confirmed by price or not. If you act on a story like this without that framework, you could be right about everything that you just heard and still be on the wrong side of a trade for days, weeks, or even months. That's the framework that I teach. The traders in my community don't get trapped by bearish narratives. They know where a trend fails, and until it does, until price confirms it, they will trade a bullish trend until it fails, even if it is against a bearish narrative. They have a framework for reading it themselves. That's the process I teach every day at emoneyaddict.com.